These business minded tasks also put you in the position of growth. And when you do well at operating rental properties, your confidence grows, and that helps position yourself for adding more properties and scaling your portfolio. And what happens when you add more properties and increase your income? You increase your taxes. Income taxes become significantly more, and you find yourself trying to figure out how to make the system work for you rather than against you. And that, my friends, is what we're discussing this week and next. Welcome to your Landlord Resource Podcast. Many moons ago, when I started as a landlord, I was as green as it gets. I may have had my real estate license, but I lacked confidence and the hands on experience needed when it came to dealing with tenants, leases, maintenance, and bookkeeping. After many failed attempts, fast forward to today, Kevin and I have doubled our doors and created an organized, professionally operated rental property business. Want to go from overwhelmed to confident? If you're an ambitious landlord or maybe one in the making, join us as we provide strategies and teach actionable steps to help you reach your goals and the lifestyle you desire, all while building a streamlined and profitable rental property business. This is your Landlord Resource Podcast. Welcome, everyone, to another episode of Your Landlord Resource. I'm Stacy, and I'm hanging out here today with my husband and right-hand man, Kevin.
Hello there, landlords. Today's episode is a really good one for all you real estate investors out there. We're going to be talking about tax strategies for rental property owners. So grab your pen and paper because we got a whole lot of valuable information coming your way.
Yep, we do. And you might be wondering why we are doing this episode in January and not in April, which is around tax season, or at the end of the year so we have time to make changes. Here's the deal. Tax time is crazy. If you have questions for your CPA, good luck trying to get them answered. And to be quite honest, the end of the year is likely too late. Not too late to gather information to include, but to implement some of the tips that we're discussing here today. Once the year ends, while there are a few things that can be done, most of your results are already set in stone and you're going to have to pay taxes based on those results. That means you need to be taking a proactive approach to tax strategy and planning by implementing strategies and taking the right actions throughout the year so you'll end up with better results come tax filing season. Because maybe last year you had to pay taxes or have had changes to your investment business, and now you need to change the way you operate and approach your tax strategies. Given this episode will drop in January, this gives you time to consider what we're saying today and then make the necessary changes so that you can take advantage of that in time for your 2024 tax returns.
That makes a lot of sense when you say that. First things we do is to give you a disclaimer. We are not tax attorneys or CPAs, nor do we claim to have any professional financial background to support the statements discussed today. The information we talk about in this podcast is from personal experience, suggestions from our CPA, and the research we have found and read to reduce our tax liability. We strongly suggest, if you have not done so already, to hire a CPA who has a strong background and specializes in real estate investments and tax preparation. Feel free to take notes and discuss any suggestions we offer today to see if they will work in your personal real estate investment scenario. The information provided here is not investment, tax, or financial advice. You should consult with a licensed professional for advice concerning your specific situation.
Yeah, we've done some extensive research to bring you tips and tricks from the experts, but we're only touching on each one of them. So if you do not have one already, your first step is to go find a CPA who has an in-depth knowledge of real estate investing. More than likely, they will be an investor themselves, and that, my friends, can only help you in the long term, much like hiring a property manager that owns their own rental properties. They're going to know the ins and outs of all aspects of being a landlord on a personal and professional level. Where this is not necessarily a two-part series, we're going to take today to discuss the obvious items you can deduct from your rental property business to lessen or hopefully eliminate what you have to pay on your taxes. Next week, we're going to dive into some not so straightforward tax saving strategies that involve time to properly and thoughtfully plan out. And all of those approaches will depend on how and who you do business with. Let's get to the standard tax deductions and talk about how you can best take advantage of those. First and foremost, there is a business mindset that all rental property owners must have. It's really hard to explain how best to save on your taxes if you're someone who doesn't operate your rentals in a business minded way. A lot of this is shown in the way you conduct yourself by the way you treat your tenants and how you feel about maintaining your buildings. Because those landlords who are willing to take the time to operate their business professionally and in an organized manner will, without a doubt, be more successful than those who don't. And I know we occasionally talk about mindset on here, but it's super important when you run a business, any business, that you approach it with a can do attitude. If you're not enjoying being a landlord, if providing housing for a profit does not light you up to a point where you want to continually improve your business, then maybe being a landlord is not for you. And we're not saying you have to manage your properties to feel this passion. Hire a property manager, it's perfectly fine. But if you think that you can buy a property and drop it in the lap of someone else to manage, thinking you won't have to ever deal with that property again, you're sadly mistaken. You need to be involved with the property by way of policies and improvements. You need to make sure your tenants are happy and being taken care of properly. A property manager is not going to do this. For the most part, they're there to collect your rent and put out fires. Tenants are your clients, and how they feel about living in your property will show in the way that they actually live in the property and pay you to do so. Very similar to the happy wife, happy life phrase, happy tenants will be more forthcoming about letting you know when something is wrong, like a leak under the faucet or something is not working correctly. If you do small things each year to make their living experience more enjoyable, the chance they're going to give back to you in this way increases significantly. Things like making sure there's no peeling paint, replacing lighting to be more efficient, adding flowers to the walkway, servicing the air conditioner, replacing old, outdated appliances, or sprucing up the backyard or patio so they can have some outdoor space to enjoy. These are not crazy expensive or time consuming activities. They're showing your client you care about them and the home that they live in. And in turn, they're going to pay their rent on time and be more accepting of increases each year. These business minded tasks also put you in the position of growth. And when you do well at operating rental properties, your confidence grows, and that helps position yourself for adding more properties and scaling your portfolio. And what happens when you add more properties and increase your income? You increase your taxes. Income taxes become significantly more, and you find yourself trying to figure out how to make the system work for you rather than against you. And that, my friends, is what we're discussing this week and next.
Let me add to your little rant there. Part of being a business owner is record keeping. This means keeping all of your documents organized, having a paper trail so that you can easily refer to a receipt to prove an expense is of utmost importance. Create a system that works for you to be able to keep all of your important and pertinent information organized. Whether that is an envelope with all of your receipts or an electronic file with scanned copies of them, make sure you can easily access the information come tax time. One thing to note is that taxes were not just designed to create revenue. The tax system was developed to stimulate the economy and influence social behavior. So when we suggest that you do what you can to operate your rental property business to a place where you are paying minimal taxes or getting a refund, you are not cheating the system. Tax benefits are provided for those who operate their business strategically. You may have heard that one year Amazon earned 9.4 billion in net profits. That's billion with a B, but they didn't have to pay any income tax on it. This took careful planning and implementing the many loopholes the government intentionally created for taxpayers. Here's the bonus for us landlords. The government encourages rental property investing by way of offering many benefits and loopholes to incentivize people to use real estate to grow their wealth.
And unfortunately, many rental property owners fail to utilize these loopholes and incentives.
Exactly. So let's delve into some common tax deductions. According to the IRS article, Tips on Rental Real Estate Income, Deductions and Record Keeping, there are several deductions you don't want to miss. The most familiar and standard deductions will be things like mortgage interest, property tax, and operating expenses. So let's talk about mortgage interest. Let's say you took out a mortgage to finance your rental property. The interest you pay on that mortgage is deductible. For instance, if you paid $12,000 in mortgage interest last year, that's $12,000 less in taxable income. Now, I want to clarify something. In 2017, the US enacted the most comprehensive tax changes in history. Some of the changes helped taxpayers, some made things worse. One thing that changed with the tax reform was a limit on mortgage interest deductions that people could take on their primary home, which was limited to $750,000 in debt. Maybe you have no plans of ever buying $1 million plus home, but this was a significant blow to many, especially to homeowners around us in California. The good part was that this limit only impacted primary homeowners and so far has not affected investment property mortgage debt. Now, this is important for investors like us who are scaling out of the single family home market and working to exclusively own only multifamily properties. Buying $1 million plus building is definitely in our plans, so this tax law is one we appreciated not changing.
Which again is all part of the goal setting that we do and involve our CPA in so that we can learn about these advantages. Some common expenses that rental property owners fail to deduct from their income are advertising fees when marketing your vacancy. Many of us might just throw the expense on a credit card and forget about it. Leasing commissions and property management fees are another. These are fees that are deducted from the rent that is transferred to you each month. So you know what your income is. You may forget to grab that number of the management fees. And for some of you, it might only be $100 a month, and you're like, it's only 1,200 bucks. Oh well. But that $1,200, along with other expenses you fail to include, can add up to thousands of dollars to deduct from your income. How many of you remember to include the fees you paid to have your taxes prepared? For us, this is a $5,000 expense, and you can bet we're remembering to include that number. Education and training is another one that is often overlooked. Did you take a class on fair housing? Did you buy a book on how to do plumbing repairs? Do you belong to a membership for real estate groups, like Bigger Pockets? Forms you buy from Easy Landlord Forms, masterminds you attend. Anything you pay for that is related to real estate, all can be tax deductible. All of those can be deducted as an expense. Did you pay your contractor to do work on your property? And did you remember to issue that person a 1099? You can deduct that expense as well. Do you have to travel to your property? The government allows you to deduct 65.5 cents per mile in 2023, as well as any parking and tolls paid for that travel. So make note of the distance to get to your property and keep track of the days that you drive there.
There are a number of apps out there that can account for this for you and uses GPS to track the miles driven. Our oldest used it when he was driving long distances as a realtor. QuickBooks accounting software now has this capability within their mobile app. We've mentioned it before, but we do use QuickBooks. We use it to invoice our tenants, and the funds are directly deposited into our bank account. We obviously use it to track and maintain all of our income and expenses, and we can do this by property and by unit. This will be more important to you if cost segregation is something you might be interested in, and we'll talk a little more about that in the next episode. The best part about using QuickBooks Online is that we allow our CPA access to a special portal for them to go in and make any necessary adjustments and pull all the information they need to process our taxes without having to download and send it to them separately. For our listeners, they're offering 30% off their monthly rate for 6 months, and they also have a free trial available too. We will link QuickBooks in our show notes so you can check them out.
Yeah, we've used them for years and they've really dumbed it down so it's not so accounting forward and it's really easy for anyone to use. Okay, to get back on the subject of deducting travel expenses, I want to dive down a little into this. Let's say you're a local and have to drive 20 or 30 minutes to get to your rental property. You track those miles and any other miles you drive to get supplies as well. If you're working there all day and decide to buy lunch for you and all the people that are working for you, you can deduct the meal as well. As long as they're all working on your property with you, you can reasonably buy them a meal.
And we just did this the other day. We're up in Sacramento working on the final touches for converting our studio into a midterm rental. Our contractor was there, and we had to go over plans of work to do at our other rentals, as well as what we needed to complete this particular unit. We went over to a local eatery to get a sandwich, and we spread all the papers we had to go over and use to make the decisions, and we talked for well over an hour. Now, what? The meal cost us about 35 bucks?
Yeah, something like that.
Yeah, okay. So we eat the lunch and Stacy takes the receipt and records who was there and what was discussed, and we'll enter that into QuickBooks.
Actually, I just read that QuickBooks now has receipt scanning. So that is perfect for instances just like this. I have not used it yet, but it's very intriguing to have an electronic copy all ready to go for us in that accounting software.
Well, there you go. Another benefit of using that software. One last thing I want to say about meals. So, with meals, you can buy meals for a potential investor, your property manager, anyone on your team, even your CPA to discuss your investment goals. You can wine and dine them, but I think there might be some limits on meals. I think like you can only deduct 50%, but regardless, a $200 dinner is a $100 write off. If you go to a real estate meetup and go to dinner before or after, you can write it off. If you go look at an investment property and want to get a bite to discuss it with your realtor, you can write that off. I mean, this stuff adds up, so keep track of your receipts. Unfortunately, with the tax reform came the loss of entertainment. You can no longer take a business associate to ball games or concerts or even the Gold Club.
I knew you were going to say that. The Gold Club, my friends, is a strip club in San Francisco. It's quite renowned, but
Okay, maybe I've been watching too much Mad Men.
yeah, you can't go there anymore.
Yeah. Okay, back to travel. When we drive to our property located in Sacramento, it's 101 miles away. That means every time we head up to the apartments and back, we are able to deduct $132.31. You guys, it's free money. We have to drive there no matter what. Do you realize how many trips we make up there in a year? Well over 20. That's over $2,500 in mileage deductions alone. I mean, that wipes out 1 month of rental income from one unit.
So let me jump in here a minute and talk about using a car as a business expense. You can purchase a car to use for your business, but you must keep track of all the miles driven for the business purposes only. And usually you'll want to use the mileage deduction for the first year and then switch to an expense method after that. The expense method means you're tracking your miles driven for business and figuring the percentage of miles for business versus personal use. You can then take that percentage of all the expenses for the vehicle, like your lease payments or interest on a car loan, your gas, your oil changes, tolls, parking, depreciation on the car, insurance, registration fees, and repairs and maintenance, and you can deduct it from your income. Usually, because this takes a lot more work to track the expenses, many people just use the mileage deduction. But if you're on it and super organized, this is something you should consider.
Yeah, we did the expense tracking for a while, but switched back to mileage a couple of years ago just because it was easier. When we get a new car, though, it will definitely be something to consider again. Now, let's say you're like Stacy and I and own rental property out of state. I realize you don't have to travel to visit it often, as you likely have a property manager. But, like we said before, don't think that your property manager is going to do thorough walkthroughs and inspections every couple of months. You may require it annually or maybe even twice a year, but I have to say, in our experience, that they are not comprehensive inspections, nor do they walk through with a contractor who is going to notice things like dry rot or water stains from leaks. It's a really good idea for you to visit your properties with your property manager once a year. This will keep them on top of things, knowing you eventually will be making yourself present there. Okay, back to travel. According to the IRS publication 463, you can deduct ordinary and necessary expenses you have when you travel away from home on business. The type of expenses you can deduct depends on the facts and your circumstances. So, you can deduct transportation to get to the location from your home, office, or place of business. You can deduct the expense to fly, drive, take a train or bus to the location of your rental. You can deduct the cost of a rental car. You can deduct fees for luggage and baggage. You can also deduct tips for meals or service people like taxi or Uber drivers. You can deduct up to a certain amount of money for a hotel room. You can deduct any phone expenses incurred for conducting business, and you can deduct cleaning or dry cleaning if you need to launder your clothes. You can deduct meals you eat when visiting and conducting business for the property. I mean, there are limitations on this, so read up in that IRS publication 463 a little to learn more about it. So, as you know, we own a fourplex in Idaho near kid number two. We strategically purchased that property so that we can use the travel to visit the property as a write off. When we are done with our work on the property, we then visit him. But the most expensive parts of the trip, the flights and the hotel, for the most part, are deductible. We make sure that each day we have something we need to do for or at that property, whether it's to do inspections and walkthroughs over a couple of days, or a meeting with the HOA director to discuss paint and sidewalk issues, or picking up supplies to do some work, or cleaning, or meeting a contractor to repair some issues found. After we are done with our business at the fourplex, we then stop gathering all the timestamps and receipts for proof and switch and use our personal credit card to pay for whatever we do with and to enjoy time with our son until we return home. And this is generally only for a day or two. We're not there for a real extended period of time.
Yeah. So, you guys, that IRS publication is about 42 pages long with a lot of detail about business travel. I will link it in the show notes for you to read it over if you'd like to. Okay. Some other expenses that landlords commonly see are for repairs and maintenance. So, anything that you do to repair something or preventative maintenance, much like servicing the air conditioner each spring, all are deductible. Supplies that you need to keep on hand, like air filters or common replacement items like toilet parts, are all deductible. Cleaning supplies or any tools that you need to flip a unit are deductible. I'll get to improvements in a bit, and that goes more with depreciation, which we're getting to soon. If you have to pay for snow removal, landscaping, or things like pest control services, those are deductible expenses. Like Kevin mentioned before, we met with our HOA contact when we were in Idaho. Our HOA fees are deductible as well. Obviously, utility expenses are deductible, and even things like internet that you may charge a fee for are also deductible. Another obvious one, which is a big one, is insurance costs. And this is for liability as well as an umbrella policy and any fees that you pay for warranty plans as well. Okay, so those were some of the most known expenses and deductions that rental property owners can benefit from. I'd like to now talk about deductions you can take for home office use. I gather that most of you, us included, work on your real estate investments from home and do not have a separate office that you rent out. If you do, great. You can write off that rent and all the expenses connected with that office space. If you have a place in your home, like a room or a portion of a room that you can dedicate into a home office, you can deduct that space and all it takes to operate the business in that portion of your home. For the home office space, you can deduct $5 for each square foot of space used. So you'll need to figure out the percentage of the home that you're using. If your home is 1,000 square foot and you're using a 10 by 10 area for your home office, you're using 10% of the home. Your $5 per square deduction would be $500 a year. You're also allowed to deduct the same percentage, in this case 10%, of the utilities, insurance, landscaping, office furniture and supplies, internet cost, and your mortgage interest that you pay for your personal home as a deduction as well. So, this is where holding on to or having your personal expense receipts on hand to use for the deduction is super important. So, think about that for a minute. Deducting 10% of the expenses you pay to run your personal home can be a huge game changer.
Do we do that?
We do, but I'm not great about all the home expenses. The last couple years, I just had the CPA use the mortgage interest and our insurance.
So the only other associated costs would be what, like utilities and the internet?
Yeah, it would probably account for about $750 of tax savings, so I guess I should include those.
Yeah, getting tax stuff together is pretty cumbersome, so I get it. But I hate to leave any money on the table if we don't have to.
Duly noted, my love.
Okay, let's move on to depreciation. I guess we save this one for last because there's a lot of variables to it, isn't there?
Yeah, more because some of the information will carry over to next week's episode, and because it is one deduction that many rental property owners do not realize does not only apply to the building.
Got it. So this week we'll touch on the more common approaches to depreciation. Many of you know you can take a depreciation write off when you own rental property, but there are a few ways to set this up. The government sees your asset as something that endures wear and tear each year. Even though your property is likely to go up in value and you get to write off any improvements you make to the rentals, you get to depreciate it over 27 and a half years. And in case you didn't realize it, depreciation is on the building only, not the land. So let's say you buy a property for $500,000. Land is $100,000 and the building, aka improvement, is valued at $400,000. You get to deduct somewhere in the range of $14,500 every single year. Now, think about that for a minute. If your property pulls in $15,000 of taxable income and you have depreciation of $14,500 and other expenses that come to, let's say, $3,500, you are now getting a refund or a potential credit towards your 9 to 5 income of $3,000. This concept allows you to keep all of your cash flow and not have to hand it off to the government. That's the simplest version of depreciation. The amount depreciation is configured from is not based on the property tax value of the property. It's the amount that you paid for the property minus the land value. This is your basis. The building is also known as the improvement. When you improve the improvement with something that, say, costs more than $750, like remodeling a bathroom, that amount is not expensed out. That amount is added to your improvements, which is accounted for as a fixed asset on your ledger. So you increase the amount of your improvement, allowing for an increase in your depreciation deduction. Now, there is also the concept of bonus or accelerated depreciation, where you can depreciate assets such as appliances, HVAC, flooring, etc., over 1 year instead of over multiple years. For 2023, the depreciation rate is 80%. For 2024, it will be 60%. Now, in 2023, we remodeled our studio unit from a tenant who had trashed it. We decided we wanted to give midterm rentals a try, so we bought about $7,500 in furniture and supplies to outfit this unit as a furnished rental. We can now use 80% of that $7,500 or $6,000 as a bonus depreciation deduction.
I am so excited about that. I think we can include all the new appliances as well, so that will be a very nice bonus for us. Okay, in addition to furniture and fixtures, bonus depreciation can be applied to many other assets. A new computer to use for your rental property business qualifies. You can even bonus depreciate your car that is used for business purposes, even if you finance that car. Unfortunately, you cannot accelerate the depreciation of the rental property unless you do a cost segregation. That can be an episode in and of itself, but we're going to touch on and discuss it on next week's podcast. All right, you guys, we're almost there. We have a few more areas where you can save on taxes, so hang in there. I want to talk about the pass through tax deduction. The IRS created a new benefit under the 2017 tax reform to allow some tax free income for real estate investors. So the first 20% of taxable income may be completely tax free. This pass through taxation is available on almost every kind of real estate income. Notice how I said almost all? The IRS defines income that is not eligible as W 2 income, interest income, dividends and capital gains income, and retirement distribution income. So, if your real estate income is not from these sources, you're good to go, and you can take the 20% pass through tax deduction. Income that is not the traditional income that you can use would be like real estate commissions, profit from house flipping, income from being a wholesaler, and property management income if you pay yourself to manage your own properties. Okay, many people confuse this pass through tax deduction thinking that in order to qualify it, your property must be held in a pass through entity. This is not true. This pass through taxation has nothing to do with legal entities. You can hold your rental property in an LLC, S Corp, partnership, or your own name and still qualify to take this 20% pass through deduction.
Let me tell you guys, that was a huge advantage for us in 2022.
Yeah, oh man, it was. When our CPA was trying to explain it all to me, I was lost. But I picked up the book on advanced tax strategies written by Amanda Hahn and Matthew McFarlane, and it was really helpful. I got it off Amazon and I'll link it in the show notes so you guys can check it out as well.
Yeah, it's always fun to wake up to Stacy's face in a book all about tax strategies.
Super sexy, huh?
Yeah, sure is. Just think of the fun we can have with all those tax savings. Read on, my love, read on. Okay, before we wrap it up, there are a few other ways to reduce the tax you owe, and that would be by getting tax credits. These are incentives you can get direct from the government for installing energy efficient goods such as new HVAC units, kitchen appliances, windows, doors, insulation, and solar panels, which can qualify you for the Residential Renewable Energy Tax Credit. Consider this scenario. You decide to make your rental property more energy efficient by installing solar panels. You could qualify for the Residential Renewable Energy Tax Credit, covering 26% of the installation costs. The Residential Clean Energy Credit equals 30% of all the costs of new, qualified, clean energy property for your home installed anytime from 2022 through 2032. You may be able to take the credit if you made energy savings improvements to your home or rental. The credit is non refundable, so the credit amount you receive can't exceed the amount you owe in tax. You can, however, carry forward any excess unused credit, though, and able to reduce the tax you owe in future years. The credit has no annual or lifetime dollar limit, except there are limits on fuel cell property. You can claim the annual credit every year that you install eligible property until the credit begins to phase out in 2033.
So, that is something that we'll be doing this year on our own personal home when we install solar panels.
Yep. And whenever you see those big yellow stickers on appliances you buy, save the receipt and put it with your tax papers so you remember to take that credit. Okay, I have a couple more to tell you about. There are also tax credits for rental property owners who rent to low income or voucher participants. I think that it's $500 per unit if you allow that. Lastly, make sure you check out your state and local authorities for programs you might be able to participate in. A few years ago, we participated in a program for our personal residents called Brace and Bolt, where a company comes in and braces your foundation and secures it in the event of an earthquake. We were able to take advantage of a $3,000 grant for participating. Now, the work cost us around $5,800 before the $3,000 grant, so out the door we paid around $2,800. But we can sleep well knowing our home will not fall off the foundation during an earthquake, and the state of California paid for half of the cost to complete this project. So, not exactly a quote unquote tax break or credit, but nonetheless a way to pay less for something you may consider doing anyway.
Yeah, this was several years ago, but for our California listeners, the program is still in place. They renew it at the beginning of each year, and when the grant money runs out, it's out until the following year. So if this is something you're interested in checking out, you can do so with the link in our show notes.
And our home is literally a quarter mile from the largest fault line that runs through California, the San Andreas. And where we shake, rattle, and roll from time to time, we feel secure in knowing that we're ready for the big one to hit.
Yeah, I think we need to update our earthquake kit though.
Definitely need to update that. I think the last time I updated it, the kids' clothes were in there, and what, number 3 was like 13 or 14 years old.
Yeah, well, that was 10 years ago, so maybe we should look at it again.
I've updated every year or so, kinda, sorta. So that's our show for today. I want to leave reminding you to create a system to track all of your personal and professional expenses. Create record keeping habits that work and organize all of your documents, whether that's using an app to digitally download your receipts or the old standby that we used for years, a 12-month accordion file. You have to become a focused tracker and totally organized in order to really take advantage of many of these tax strategies.
Yeah, you guys, we can't emphasize enough that being organized and maintaining accurate records is crucial. It not only helps you during tax season, but also if you ever face an audit. Adopting a business owner mindset can make a significant difference. Treat your rental properties as a business, and you'll find more opportunities for deductions. And we'll link that 12-month accordion file in the show notes because it's a great way to start out with organizing and filing your receipts if finding and using a digital option is too much to deal with right now. Next week, we're going to continue to discuss tax strategies, but ones that are not so obviously known. This is where you go from being a rental property owner to being a true entrepreneur. We will be discussing hard stuff, the stuff that all those successful real estate investors do to avoid having to pay taxes on their huge portfolios, like how to get the real estate professional status to really get huge tax advantages, as well as how holding your rental property in certain legal entities can have a huge payoff. Cost segregation studies, 1031 exchanges, and creative ways to use your IRA and retirement funds to purchase your next rental property. Yep, you heard that right. You can use your IRA, Roth IRA, personal 401k, etc. to buy rental property, and we're going to go over how you can do it next week. It's not super difficult. It's just one of the many loopholes that the IRS created in their 2017 tax reform. All right. Now, that is truly our show for today. Thank you for listening to all we have to say. We really do appreciate each and every one of you taking the time to tune in and all of your kind words. They all mean so much to us. So let's keep working together and getting the word out to other landlords. If you love what you hear, would you do us a huge favor and leave us a kind review so we can continue to reach other rental property owners? We really need other listeners to know how our podcast has helped you and what you love about listening to us each week. You can find a link in the show notes for your review. And while you're at it, would you also follow or subscribe on your favorite podcast platform? Your downloads each week allow us to grow and reach other rental property investors. And lastly, we'd love to connect with you. We have a great newsletter with all kinds of tips and articles for rental property owners, and you can sign up for it. It's free. We will link it in the show notes along with links to our Facebook group and social media sites. And remember to take advantage of the tax strategies available to you that make the most sense for your rental property business. Until next time, you've got this, landlords.